So bond markets. Bond markets are very different from stock markets. Stock markets have electronic trading systems, they have exchanges and so forth. Uh, that is not the case with bond markets. They're primarily over-the-counter transactions that with dealers connected through electronic networks. The there's a large number of bond issues, but generally a low daily volumes and individual issues. The exception to that would be U.S. Treasuries, but the bond market is actually many times larger than the equity market. If you are interested in employment in the securities industry, there are many more jobs available dealing with bonds than there are with stocks or equities. So it this limited trading can make getting up to date prices are very difficult, particularly on small company and municipal issues. As I mentioned, treasuries are the exception. The Treasury quotations. So here, this is a quotation. It doesn't say whether it's a note or a bond, but the 26th May 15th. That's a maturity date. The coupon rate. It's going to ask all these questions as we go through, but the coupon rate is 1.75%. These are the next two are the bid and the ask price. So the bid price is the price at which a dealer the dealer will buy the bond from you, and the ask price is the price at which the dealer will sell it to you. So if you wanted to sell this bond, you would receive 97.1953% for every $100. If you wanted to buy it, you would pay 97.2109 or 97.2109% of the every $100 of value. So again, so the coupon rate 1.75 matures May 26th of 2015. Then the bid price is this 97.1953, and then so we already talked about what it means. And the last, how much the price changed, it changed by 0.3438 from the previous day. The last item here is the yield to maturity based on the ask price. So the clean versus dirty prices. So clean price is the quoted price. The dirty price is the price you actually pay. It's the quoted price plus accrued interest. So we have to add in the accrued interest, assuming we're not trading them on an interest payment date. So if we have a treasury bond that in the previous slide, and today is is January 15th. January 15th is 61 days since the last coupon. Number of days in that coupon period is 181. The accrued interest is going to be 61. So we're paying interest on the portion of the period that has passed. That's 61 divided by the 181. Then we multiply that by our coupon rate. So of 1.75%, so 0.0175. We divide that by 2 and we multiply it by the face value. So that would be a $2.95. So the clean price for a $1,000 bond would be $972.11 plus the dirty price is going to be the $972.11 plus the $2.95 of accrued interest. So this is what you would actually pay if you bought that bond on January 15th. So $975.06 is the amount of money you would have to. Next, inflation and interest rates. So we talked about the Fisher equation previously. This is basically we talked about that in relation to company cash flows. The same thing has the same impact on bond cash flows. The real rate of interest, it represents the change in purchasing power. The nominal rate of interest is the rate that you actually see. It includes a change in purchasing power plus inflation. So the ex-ante is just after the fact. It means after the fact. Nominal rate of interest. I'm sorry, ex-ante is before the fact. Sorry, the ex post is after the fact. The nominal rate of interest includes our desired real rate of return plus an adjustment for expected inflations. So real versus nominal rate. So 1 plus R is the nominal rate. This is the Fisher equation. Is equal to 1 plus the real rate of interest multiplied by 1 plus the H is the expected rate of inflation. And I don't ever understand why, but people use all sorts of, sometimes they use pi for expected inflation, sometimes they use I. So it just adds to the confusion. Here we use H. So R is the nominal rate, capital R, little r is the real rate, H is an expected inflation rate. So we can also use an approximation of this formula for low rates of interest. The nominal rate is equal to capital R. The nominal rate is R is equal to the real rate plus the expected inflation rate. There are inflation-linked bonds. Most bonds, all bonds face inflation risk, so forth. But the Treasury issues what are called Treasury inflation protected securities, TIPS for short. What they do is there's a set coupon rate, but the value of that bond is increased based on the changes in the CPI every year. So the CPI goes up by 3%, the value of that bond goes up by 3%. So as a result, the value goes up and the interest payments increase on an annual basis. So, all right. So we'll start the next lecture with a Fisher effect example.